And welcome everybody, and thank you for everyone at TradeThirsty for putting on again another epic event. Couldn't be a better time. We are in some interesting market conditions, to say the least. So we will kick off with a standard disclaimer. Today will be for educational purposes only. Acorn Wealth is a educational company only, not a registered financial dealer in any jurisdiction or province. We will be talking about live positions that we potentially are holding ourselves, but again, not a recommendation to buy or sell. So let's get right into things. Right now, we are in a situation where the market is in some very precarious positions. We've got a lot of different factors that are facing the market, including the trade war in China and a whole bunch of different things. So when you've got all of this noise going on, it's important to have a way to decipher what is really happening. What's really important, what's the truth of the issue, and how do we kind of diffuse all of this what down to a decision or rule-based decision process of how we decide, are we going to go long, are we going to go short, how much perhaps in each direction, and how much do we believe in that conviction. And there is a way to do it without guessing and buying into all of the BS, essentially, that you get from the news, and that is by following the smart money. And we're going to be talking about how we do that, and how we can and how we've used it over the last 12 years. We've been teaching it to predict many of the big major turndowns, because what we're going to be talking about today are the same systems we used in our infancy when we predicted the 2008 crash. You've all seen probably The Big Short with Christian Bale and all those actors. Look, we were right there with them. We nailed the 2008 short. We nailed the 2010 European Union crisis crash. We were there when we nailed the crash in January of 2018. For those of you that were following us, we predicted that days before it happened, and we were right there in 2018 in October, when the market took a over 23% drop right at the end of September. Once again, we were there doing a very similar kind of presentation, saying, look, this is imminent, and it's time to get short and take profits on your longs. And here we are again. So the systems that we're using are things that we've used to pick our own trades. It's how we manage our own money. This isn't just theoretical. They are real trades. And they apply very much so to what we're doing in the market right now. And the whole idea of what we do and how we've been teaching for the last 12 years is how to incorporate systems to make those kinds of decisions. It's not a crystal ball. It's all about tracking. Where is the smart money going? And by smart money, I mean the algorithms, the high frequency traders, the big managed money, and of course the insiders themselves. Because when you can see where that's going, keep in mind they know far more than we can possibly ever know. They are far more skilled in terms of being experts in their individual fields, and that tells you the truth of what's actually happening. And that's a very simple and very powerful way to predict explosive moves before they happen. And that's what we're talking about. So in terms of looking at where we're currently at, the market is in a very dangerous situation. The market conditions over the next few months could potentially be devastating for most investors or traders. But if you look at it the right way, these are actually ideal situations where we're getting moves in the market that would otherwise take typically months, if not sometimes a year, to cultivate. But we're seeing them transpire in a matter of weeks or months. Now, as long as you can predict and anticipate where these big turning points are, this is exactly what you want as an investor or trader, because you're seeing movement that is capturable, and the time frame being shortened down. So rather than thinking in terms of whether you are a investor or a trader or a day trader, think in terms of capturing the movement, and we certainly have a lot of that. So to give you an idea, to jump straight into the depths of what we're trying to look at or look for here, we're going to go back to 2018 in terms of one of the short calls that we had published to our students, and that was a short on PRTY. And to go straight into the deep end, this is a great example of the kind of short or trade in general that we're looking for, one where all of the ideal things are lining up perfectly. And this was on PRTY. So firstly, let's consider the fundamentals, because maybe some of you out there in the audience consider fundamentals. Maybe you're the type of person that says, well, John, it's not all technicals. It's not all about where you draw those funny looking lines and channel extensions and Fibonacci's. That's not everything. There's more to it than just technicals. What about the fundamental story? What about the underlying drive of whether this is a good company or not? Now, a lot of people, and I'm not discrediting that, by the way. So a lot of people will drive their investments by some kind of special idea they have about this company. This is the next best thing since sliced bread. This company is doing wonderful things. This is going to be the next biggest gold mine. This is going to be the next biggest tech company, etc., etc. Now, generally speaking, people formulate these fundamental pictures by trying to become an expert. So, going through and researching all the different reports on the company, looking at Motley Fool, listening to guys on TV jumping up and down and playing funny noises on the television shows, going through all the bulletin boards and stock twits and etc., and becoming a true believer, a bit of a groupie for that stock. Now, that's very difficult because, one, you're not probably an expert in that field. You haven't spent 30 years being a pharmaceutical expert. You haven't spent 30 years chipping away in a close-cut mine looking for resources. You're not Goldman Sachs that spends billions of dollars on, for example, renting satellite footage to survey mine sites for when increased levels of activity are going on, to be able to predict ahead of the market when big announcements are going to happen about a find. We can't compete with that, and it's very difficult and laborsome to go through all that kind of research. But sure, the fundamentals matter. So what we can do is we can go and have a look at what the experts that do have all of those qualifications and resources are doing. And when we look at PRTY, for example, as one of our favorite shorts from last year, we can see that the people that knew best were dumping all of their stock. So we can see that the directors and 10% owners were selling 100% all the way through in the order of $242 million, for example. 77%, 21%, 22%. They were jumping ship. They were selling everything. And that says something. And when we go have a look at the chart, you can see that at the same time this was going on, the technicals, or in other words, the pattern, you can see was forming this nice big upward channel. And so for those of you that don't know about the rules of patterns, patterns are very important because they are one of the very few leading indicators of what's going to happen next. See, a lot of indicators out there like your MACD and your moving averages and relative strength index, etc., etc. All of these things are lagging indicators. They only talk about what's happened before. But patterns are the Google Maps of the stock market. They are the roadmap, the guidebook to what the market makers or the smart money are going to do next. They tell us based on what's happening before exactly what the probability is of what's going to happen next and exactly how to trade it. So patterns are very important. And when we look at the pattern in PRTY, we have this clear upward channel. And an upward channel is bearish. It's not a bullish pattern, despite when you look back, it shows you that price is increasing. What it shows you as a leading indicator is that it's due to drop next. And it's due to drop after 3 touches along support. 1, 2, 3. There is a 67% probability it's going to drop by at least that amount. And that's exactly how much it dropped by. We also had the insider selling. So that accounts for the fundamental story or that part of the picture. And we can also see down the bottom this indicator, which we call the smart money indicator, which was developed by Colin Twiggs, and it's called Twiggs Money Flow. And what this does is it looks at all of the levels of price action, such as whether the stock's making higher highs, lower lows, the volume that's coming along with it, all of these things that truly describe an uptrend or a downtrend. And we can see that this is going straight down. So this also tells us that smart money is offloading as price went up. So you have a 1, 2, 3 punch. The pattern is perfect. That indicates a short. The smart money in terms of algorithms, they're selling as well, which means they're preparing for that same move. And on a fundamental level, so that we can consider what might be going beyond the chart, what might be going on beyond the chart, they were dumping it as well. And as you can see, this absolutely plummeted. So that's the kind of setups that we're looking for. And this is not just hypothetical, this is exactly how we trade ourselves. In fact, throughout this last 6-month period, most people would describe the market as unpredictable, chaotic. But everything that I'm about to show you today is stuff that we've traded with our own money that we do ourselves. And that's an important thing to know if you're going to buy into a mentor or a strategy. So as you can see, throughout that entire chaotic period, we were able to average 14.58% per month in terms of real money results with our actual money trading account. So to bring this back to, again, the idea of having a system, the reason why most people fail is because they don't have one. And as a result, because they don't have a system that tells them to buy here, a system that tells them this is where you should sell based on probabilities. And in turn, this is where your stop loss should be, or this is where you should update it to. They don't take action. They're the deer stuck in the headlights, and maybe you felt like this over the last few months where market directions have changed violently. It's not chaos. It's not a reason to throw your hands up and say, I quit, I can't figure this out. It's telling you that you need to be able to refine your skills in predicting these types of things. And that's why most people lose money. It's not because they're not intelligent. It's not because they don't have skills. It's because they lack a strategy. They're investing emotionally. And that's exactly what smart money wants. They're constantly giving you all of these reasons, or all of this noise to to confuse you, to make you feel emotional. But that's what they want, right? Just remember that the smart money are not there to help you. So if we come back to our example that we've just talked about before on PRTY, how many people have ever heard of a director of a company or a CEO coming on television and saying, "Hey, everybody, I just wanted to let you know that although things are going on fantastically and we still expect business as usual to be continuing to be positive, I just wanted to let you know that next week I'm going to sell 70% of all of my stock. And hey, the other directors of the company and 10% owners, they're going to get out too. In fact, they're going to sell all of their stock, and we're going to dump it all in the open market." How many people have ever heard of that happening? Never. Because if you're the CEO and you're dumping $271 million worth of stock or selling 70%, you're the last person that's going to hear about that until days later, maybe even months later. Maybe you're not even aware of it when that's going on, because they need you there to continue to buy if they're going to be selling their stock to somebody else. So while many people get caught up in this intelligence trap of wanting to figure out what the next big move is going to be and do all this research, just remember that the smart money know better. The CEO of if the CEO of the company is going to sell 100% of his stock, and so is the chairman of the board, and so is his executive vice directors, and so forth, if they're all selling, are you really going to say, "I disagree with them, the top people in that company are wrong. I know their company better. I think they're going to make lots and lots of money, and now's a great time to buy all that stock off them"? Right? Are you going to do that? Or are you going to think that perhaps they know something's up, something's going on? So that is a much easier way to condense all of this research you're doing down to allowing them to do it for you and follow the smart money. And it matters, right? It matters a lot, because at the end of the day, that's what moves a stock. Whoever controls the volume is going to control the price. And when we go a level deeper beyond just the insiders themselves, we start to look at things like high frequency trading. So right now, the JP Morgan estimates that 90% of volume in the market is controlled by computers, controlled by algorithms, deciding when to buy and sell based on patterns. They also estimate that 60% of globally managed money is making decisions the same way. So this is all being done based on patterns, based on things like upward channels, saying here is where we short, here is where we cover, here is where we buy, here is where we sell. All of these things are predetermined and programmed into pattern-based decisions that are automated, and billions of dollars are being made by this. So when you start to think about anyone here in the audience that might day trade, or anyone here in the audience that's a swing trader, where you're looking for a 1 week to 3 week move, but more importantly, anyone here that sits there during the market and watches their stock every hour or every day, reacting to what's happening, ask yourself why. Why are you needing to watch it so much? Because if you know what would constitute a perfect buy, in other words, what exactly does that chart need to look like in order for you to get in? What does that chart look like exactly in order for you to sell? What exactly, based on that chart, do you expect the stock to do? And of course, if you're trading options, this is the same thing because it's all dependent on the underlying asset. If you know what you're looking for, then why do you have to sit there and wait for it to happen? Because algorithms don't. They've been able to program exactly what they're looking for so that the computers can do the work for them. And that's the point. When you start to reverse engineer the system and realize that this is all very much a situation of organized chaos, we can pre-program our own algorithms, our own brokerage accounts to buy and sell based on the same rules that these algorithms are following. So when we start to look at the most important components of constructing a really powerful trade, really what we need to figure out and what we need to determine is, one, what are the most powerful patterns to trade and how do we find them? And secondly, how do we take that a level deeper beyond just the pattern, beyond just the technicals, to increase that probability much, much more by having the insiders loading up or getting out, depending on which direction the trade is at the same time. So let's start this from let's start putting these things into a strategy. And where we'll start from is we're going to look at the overall stock market. And this is a very a funny term, and you can see I put this stock market term in parentheses because there really isn't anything called the stock market. There is no such thing as the stock market. And this is what one of my mentors taught me over a decade ago. He said, "Johnny boy, there is no such thing as the stock market. It is a market of individual stocks." And this is so very relevant right now to what's going on in today's market. Just for an example, on Thursday of this week, let's just bring up the chart here. On Thursday of this week, and mostly all of this week, you can see the S&P 500 has been going straight up. Okay, now, but how many people here in the room have seen the S&P 500 going straight up, but have not been making a lot of money out of it? How many people in the room today are experiencing that? The market's going straight up, powerful bull move, but they're not seeing that in terms of results in their portfolio. Okay, I'm getting a lot of people saying yes. Now, if you're in that boat, this is going to be very relevant to you. And if you're not in that boat, fantastic. You may be in some very good positions. When we delve deeper behind what the stock market's doing and what's really going on, here's some fun facts. On Thursday, the S&P 500 rallied up, but did you know that only 490 companies in the S&P 500, or in the entire market, sorry, went up more than 2%. However, over 1,000 stocks went down more than 2%. I believe it was something like 220 stocks went up more than 4%, but over 500 companies went down by more than 4%. So how does that make sense? How do we have twice as many stocks dropping by big percentages than those going up? However, the S&P 500 is so bullish. Well, because it's not a stock market, it's a market of individual stocks, and the S&P 500 especially, such as other indexes, are very easily manipulated. So one of the indicators that can be incredibly powerful to look at is to look at the something called MMFI, which is the percentage of stocks above or below their 50-day moving average. Now, if you have TradingView or Incredible Charts or barcharts.com, you'll be able to find this indicator is available for free. You can also go, and if you don't have one of those platforms, you can search for this indicator on Google and find barcharts.com or tradingview.com and look at it for free. And this is what I'm going to share with you today. It's a very powerful system because it goes into this idea of the market versus what's really going on. And if we go back to see how this is applied in all of these recent crashes that we've nailed, and and I say that not for bragging rights. Well, I kind of do for bragging rights a little bit, but it's also something you can easily do yourself. When we predicted the 2018 crashes, as well as the 2015 crashes and the 2010 crashes and the 2008 crashes, we were looking at this indicator and we saw that, for example, in 2015, look at what the S&P 500 was doing between April, May, June, July, August. The S&P 500 was going sideways. It was doing nothing. It would be described as a sell in May and go away lifeless market. Then all of a sudden on August 19th, the market plunged 10% unexpectedly. The market then recovered all of its losses by November. And then on December 29th, the S&P quote unquote surprisingly dropped another 13%. But when we compare this to what was going on with the real market, it's a different story. Now, here is that MMFI indicator that I was showing you before. Notice on the right-hand side here, we have a number. Now, this number represents what percentage of stocks in the market are above or below, well, in this case, above their 50-day moving average. So in April, what we saw here was that we reached this level of 70% of stocks were above their 50-day moving average. Now, the 50-day moving average is important because it represents institutional or smart money support. Where the hedge funds would buy, where the institutions would buy, etc., etc. And when a stock drops below this level, it's an indication that they've lost that institutional or smart money support. So when we hit the 70% level in April, that was the top of the market. And while the S&P 500 went sideways, notice that by the time that the index even started to drop, we had already decreased from 70% of stocks above their 50-day moving average down to around 30. Right? Does that sound like a bull market to you? Does that sound like a directionless market to you? Because underneath the surface, individual stocks had been plummeting since April, but we didn't see that reflected in the S&P until this day here. Now, if you look at the fact that the S&P 500 then recovered all of its losses and didn't drop again until December 29th, look at the fact that once again, by December 10th, the individual stocks once more had dropped from 70% down to 26% before the S&P 500 really even budged. So again, it's not a stock market, it's a market of individual stocks. And you can see the same thing here in the most recent crashes of 2018. First and foremost, here's the pattern. As you can see, there were two beautiful upward channels on the S&P 500, which told you the thing was going to drop. Once again, after 1, 2, 3 touches, that was to a high degree of probability going to break down whatever that distance was, which is exactly what it did. It dropped not close to, but exactly where that pattern told it to. And after that, we had 1, 2, 3 touches along support, and that also told you that that was where the S&P 500 was going to drop further. So you can blame it on interest rates, you can blame it on Trump if you want, you can blame it on the trade war, but if you knew nothing about any of those things and all you understood was the power and probability of patterns, and the fact that 90% of the market is going to make decisions based on that, you didn't need to understand those other things. All you needed to understand were the rules and the probabilities of where things were going to go. And the entire price action of everything that happened in 2018 could be described and predicted by understanding the rules of an upward channel. As simple as that. But we all like to fall into that intelligence trap. We all like to make things so much more complex than they need to be, when really the trick is just to keep it simple. And once again, when we look at the smart money indicator here, we can see that in 2018, once again, before we crashed, we had rallied up into that 70% area. And right before that first decline in January, and again, before the crash of October, you can see we had rallied up to that 70% area in June. So even though the S&P 500 didn't drop till October, notice that the stocks in the market had declined from 70% all the way down to around 30% before the S&P dropped. So just like the question I asked you earlier, how many people here are seeing the market rally but not making money on their stocks? Well, there's been many situations like this, because the S&P 500 is heavily manipulated and doesn't truly reflect what actual smart money is doing or where the real direction is going. Okay, and if you go back over 10 years of history, this has been consistent that any time that we've gotten over this 70% level, the stocks in the market have never stayed at that level for longer than 4 weeks. In fact, 100% of the time over 10 years, whenever we get to the 70% threshold, 80% of the time, that is immediately where stocks start to decline. And the other 20% of the time, they never last more than 4 weeks. So this is a very powerful indicator in seeing what the real market is doing. So not an unpredictable market or an unpredictable flash crash. And as I said at the beginning, this isn't just hypothetical stuff. We're not just looking back and saying, wouldn't it be great if you'd seen this? Wouldn't it be fantastic? And how obvious it is now. These are things that we do ourselves in real time. When we saw this all lining up, when the upward channel was ready to break down, when the high yield bonds were breaking down, when the stocks above or below the 50-day moving average was down 30%. You know, we put a big chunk of money, 130 grand, into shorting the market by buying an inverse ETF called TZA. That rallied from around 950 where we got it at to 18 bucks. We bought the inverse ETF SQQQ. We put 99,000 bucks in that position, shorting the Nasdaq. using an inverse ETF because the rules told us to. We were able to make decisions with confidence, not because we could forecast the future, but because we had a rule system that told us what to do and that it was a high probability trade. And we bought options. For those of you that trade options, we also bought call options on TZA if you're more of that kind of trader. And again, same kind of result. So that's all possible only because the rules tell us what to do and we're keeping it simple, right? We're keeping it simple, and that doesn't mean it's less sophisticated. Because here's the problem: is that most people, I mean, all through life. I was talking about this with a friend last night over a glass of wine about how in school we get trained to be employees. We get trained how to work a 9 to 5. We get trained how to conform. We get trained that the harder you work, the more hours you put into a day, the more money you will make. But that's not what the stock market's about. Firstly, investing is not about working harder. Investing is about your money working hard for you. But most people are stuck in this mindset that the more research you do, the more indicators you have, the more newsletters you read, the more money you'll make. It just doesn't work that way in investing. It's about efficiency. And in a lot of cases, it's about keeping it simple rather than overloading with input. And so if you can let go of the attachment to time in, work in equals profits out, you can start letting go of these this rat race. So some examples now when we turn ourselves to trades of how this translates to a trading perspective is things like VSM. So now we have developed a system of being able to look at market direction and which way the market's likely to go, not based on the S&P, not based on what we hear in the news, but based on high probability patterns and what individual stocks are doing. We can then decide, okay, well, what types of trades are we looking for? And in this kind of market, you need to have the mentality that if you're going to go out there and go long a stock on Monday, that you need to be confident that even if the market was going to go down 5% next week, that was still a long that you would be happy to buy, because you are so confident that long, that stock, has a strong independent story, or in other words, the salmon swimming upstream. And in the same turn, if you were going to go short a stock tomorrow, you would need to be confident that you would still take that short, even if you thought the S&P 500 was going to go up 5% next week. So what I'm saying is that you need to detach from market direction and look for those independently very strong or weak stories where the stock has a life of its own. Does that make sense to everybody? You're looking for that special scenario. Sorry, I put myself on mute there. Yeah, so VSM is an example of this. So have a look. So VSM was a stock we picked out on January 30th for our students. As you can see, the insiders were loading up, right? You've got the directors, multiple directors, especially Susan Schnabel, buying double digits again and again and again and again, increasing her position significantly. So were the other directors of the company. Now look what happened after January 30th. the stock formed what's called a flag formation. Well, actually, there's two patterns. One, you had a downward channel that broke to the downside. So a downward channel is bullish, and when it breaks the wrong way, that's like pulling the elastic band back even further for an even more powerful bullish move. You also had this flag formation that happened here. So on VSM, on January 30th, it was a very high probability setup. The insiders were loading up, and you had a very powerful pattern to boot. And as you can see, that rallied from $37 where we picked it at up to 50. Right? Now, again, look at the indicator down the bottom, the smart money indicator. You can see that this powerful indicator was going up the whole time this stock was making significantly lower lows, showing you that the smart money was loading up and perhaps even creating that decline to push the stock lower so that they could accumulate a lower price of entry. Check out ZYNE. ZYNE. Again, look at the buying. You got 70% increase from the chief financial officer. And there's only one reason people buy, and that's greed. And there they are, loading up. You've got 10% increase from the the secretary. Brand new buying from a director who's never bought before. This was an alert we sent out on April 16th. And again, have a look. The thing skyrocketed from, again, this flag pattern. There was our entry point, and that rallied all the way up to 1550. And what's better is that when you start to know what you're looking for, you can automate it. So again, a lot of people, a lot of students I run into and that we've worked with over the years, they'll say, "Oh, look, you know, I'm struggling with my trading because I have a day job, or I'm struggling with my trading because I can't watch the market all the time." When really, when you think about it, remember 90% of the market isn't watching the market. 90% of the market, 90% of the volume, 60% of managed money is all predetermined rules, where to buy, where to sell. So why would you be working harder? Why? You don't need to. So on ZYNE, based on the pattern, and as we do with every one of our trades, we were able to set and forget. We bought at 875, as you can see down here. We pre-programmed to sell at 1137 and a stop loss at 743 based on the rules of the pattern, and we just let it go. And as you can see, I mean, this was taken when the stock was $10. We had a $1.25 thousand profit, but that ended up going all the way up to our target, and everything from entry to exit was all automated, set and forget. MAXR alerted on May 16th. Again, look at the huge accumulation from the CEO, the group president, the director, the chief technical officer, the director, all loading up double digits at the same time. And once more, from the alert on April 28th, the stock went from $5.12 to $8.90 in just 3 weeks. And once again, look at the smart money indicator down the bottom, rallying up. You got this kind of beautiful accumulation pattern on the stock. So big moves. But also, again, to the short side, IONS. At the same time we're buying these longs, we're also going short. So we're going in two different directions because of the individual power of the trade. So on IONS, which we picked on and bought on May 2nd, you can see the insiders dumping it, selling out. And when you look at the pattern, you have this upside down flag, right? There's the flagpole. There's the flag. and therefore there was the target. Very easy, all pre-programmed. And so that hit our target on May 8th, just about 4 days of trading for almost 100% profit, and all pre-programmed based on the rules telling us what to do. And as I said, this is the stuff that we trade. IONS, bought that, there you go, July 19th, $70 puts, bought at 574, right? In fact, there's another one, CLB, on May 2nd, shorted that at 59.55. Have a look at that. We just covered that short on Friday, dropped from 59.55 all the way down to 50. Look at the smart money indicator. Everything telling you to go short. It's the same thing. Again, as I said, this is all stuff that we're doing with real money. FN. Look at FN. Look at the insiders. So if you like fundamentals, if you think that it's more than just these funny patterns and funny little indicators, sure, okay. Well, then let's do the best kind of fundamental research we can do. Let's ask the CEO and the directors of the company what they think, because they know better than anyone else what the fundamentals look like. And when they're dumping, that tells you something. And you can see they were dumping here. So when that stock broke down through $53, once again, look at the pattern. You've got an upward channel, 1 touch, 2 touch, 3 touches. There's the break, and it broke down exactly the distance between the upward channel right there. And that was 100% profit on those options in 1 day. So we bought the FN puts at $4.80 on May 17th, and by May 23rd, 10:40, they hit our target. All rule-driven, all process-based, right? So that's the important thing. And when you know what you're looking for, this becomes possible. You can start scanning for it because you know what you're looking for. If you don't know what you're looking for, there's an old saying that says, any road, if you don't know where you're going, any road will take you there. When you know what you're looking for, you can become efficient and you can create scans to find exactly what makes the perfect buy or the perfect short. Otherwise, you're wasting time and you're wasting opportunities looking at all the noise. So how do we do this? And how can you take a step further in this process? Well, what we've done is we put together a terrific, I was going to say module, but it's really an entire course because it actually goes through from start through finish, everything you need to do to replicate this and scan for it and trade it. So a lot of other courses out there will, you give you one indicator, or a lot of courses out there you'll be reliant on, on a black box approach. What we do is we teach you everything and we show you the magic behind the system, behind the curtain. So in this course, we've broken it down into 3 different modules that you'll receive immediately tonight or today. The first module covers the smart money indicator perspective in terms of the overall market, so a top-down approach. So in module 1, we're going to look at, okay, how do we use MMFI to predict market tops and bottoms? What are we looking for exactly for a market signal? MMFI, as impressive as it is and as amazingly accurate as it is the least powerful of the 3 indicators in this module. So there's 2 others that are included here, including one that predicts the S&P 500 direction for up to 2 weeks, and back tested to 1960. It's had over 1,300 alerts, and it's close to 90% accurate. That alone will blow your mind. So in module 1, it's all about the smart money indicators. In module 2, we then go into the patterns. So how do we use the patterns to then well, when we know the market direction and what kind of are we looking for longs or shorts, what are the patterns that we're looking for, and how do we scan for those? How do we trade those? What are the core characteristics that we're looking for in a very high probability pattern, so we can replace guesswork and anxiety with confidence and process rule-based decisions. So you're never wondering what to do. It's right there, and there's black and white rules as to how you do it. And all of this leads up to then going through the scans, where we then teach you and give you for life the scans and the software to go and replicate exactly how we find them ourselves. We're going to teach these scans to you. You'll then have them for life. There's no recurring fees for any of this. The indicators are included for life. The modules on patterns are included for life, and the scans and access to them, the data feed included for life, where you can go in and then run the scans searching for the highest probability smart money longs, where multiple insiders are loading up in very, very heavy amounts, as well as the short scan looking for the inverse effect. Okay. And so the first 2 modules will give you all the foundation skills so you can jump into these scans and then run them and know exactly what you're looking for. So there is no software at all included. Everything you need is to do this is included in the package, and we've also programmed so you'll be able to use what we provide for you. If you do have your own platform that you want to do some of this in, we have set the smart money indicator up into NinjaTrader, TradeStation, Metastock, Incredible Charts, Thinkorswim, TradingView, and TC2000. But again, if you don't have one of those programs, we can provide one for you. So you don't need to bring anything to the table, so to speak. Okay, so let me answer some questions. Let's have a look at what's coming in. Why are the other stocks not going up? The ones that I hold outside the 500, because the market is manipulated. And in 2016, for example, 1/3, which was a big year for the market, big rally, 1/3 of all of the gains that happened in 2015 were accounted for by 5 stocks. So there's an institution out there called the Federal Plunge Protection Team, which is a government organization that's sole purpose is to prop the market up and allocate money to buying assets to make the market go up. In 2008, when the market crashed on June 6th, there was 68% of stocks were declining, despite the fact the market went up, I think it was 1.7%. That's a dangerous sign. So these are the kinds of things when it's just beneath the surface. You can see what's actually happening. Okay. Why are 3 touches important? Because that is the probability of when a trade will break down. Gary, so when you get out, when it breaks the lower support channel, well, we get in to a short. So I would never be going long an upward channel because it's a bearish pattern. So rather than trying to trade what's going on right now and be reactive, I want to anticipate what's next and wait for that trade because that's the higher probability setup. Peter, wow, the people up in Vegas would say you're trying to make your point the hard way. Oh, yes. Well, I'd like to make my point the hard way versus you learning it the hard way by losing money. So yes, absolutely. How can you scan for these stocks? Gary, right there. We'll teach you all of that in this course. Okay, does this work on TradeStation? Yes. Can you get the scan before the open? Yes, all of the trades we do are all before the open. I don't, in fact, as a rule, I don't watch the market or trade when the market is open. All of the trades I do are pre-programmed at night. In fact, like personally, I found that if I sit down and micromanage my trades when the market's open, I tend to lose money because I'm acting or trading emotionally. I love the idea of setting and forgetting and just letting it run. You know, NTNX is a great example of that. This was another short that we had recently. In fact, we shorted it twice. We bought put options on this right before earnings because there was a very high probability pattern. As you can see, there was a beautiful head and shoulders. So we bought puts on this the day before, sold them the morning after for a 450% return. And then it created another beautiful head and shoulders right here. So we bought puts right there, and we just sold them the other day when it broke down to its target. All pre-programmed, all automatable, and huge insider selling. Do I share my calls on the market? Absolutely. We are very transparent. As I said, this is all real money stuff. So again, beyond the course itself, where you'll learn how we do everything, we'll also be giving you our alerts. So for an extra $9, you can add this on. You'll see the option after you've enrolled. It'll ask if you want to add on the smart money alerts. So obviously in the course, we're going to be picking out trades for you. But if you want to continue to receive them for the next month, it's $9. We'll be sending you a video every night, about 4 or 5 minutes long, telling you exactly what we're going to do with our own money or any other trades we're considering to enter into the next day. Entries, exits, options that we're looking to buy, the whole strategy and all the research behind it, and you can add that on for $9. And if you decide to continue on past that month, it's only $59 a month for the alerts. So and all of that will be in your package as well. So you can really immerse yourself in how to automate and trade like the smart money, which in these market conditions, it's the absolute perfect time. So now we're actually out of time, unfortunately, folks. I've loved I've loved our session today. So look, if you do have any other questions at all, there's the information. You can give us a call or drop us an email. But I'll pass it back over to Jeanette. And again, once more, trade like the smart money. They know much better than we ever could, and it's easy and simple to follow. Thank you, everyone, and over to you, Jeanette.